In this video, we're going to be discussing sales variances. There are two types of sales variances. One is the sales price variance, the other is the sales volume variance. Unlike the other variances that we've learned about with materials and labor, we do not use the tiered system or the upside down pyramid to calculate these variances. That is because the two different sales variances don't depend entirely on overlapping data. And so we will go through and take a look and see what the calculations look like for each one of these variances. The sales price variance is the change in contribution margin due solely to the change in selling price. This equals the actual number of units sold times the actual selling price per unit minus the budgeted selling price per unit. Another way to think of this a little bit more simply is the actual number of units sold times the difference between the actual and budgeted selling price. So here we have an example at the bottom. A company has budgeted sales of 10,000 units at $17 per unit. The company actually sold 11,000 units at $16 per unit. Variable costs were expected to be $10 per unit, and fixed costs are expected to be $50,000. So we're going to take the actual units sold, which was 11,000 units, times the difference between the actual and budgeted selling price. So the actual selling price was $16 per unit minus the budgeted selling price per unit, which was $17. This means we have a negative $1 when we look at 16 minus 17. Then we'll multiply that by the 11,000 units. We have an $11,000 negative result. And this is unfavorable in a sales variance. This is different than what you're used to seeing. In the other variances that you're familiar with, materials variances and labor variances, negative is favorable. That's because in those cases, they're related to expenses and other costs. And so the less cost you incur, the better it is for the company because theoretically the higher the profit. And so in those cases, negative numbers are good because it means that you spent less or you used less. But now we're on the other side of the coin. We're on the sales side. And on the sales, negative means that you sold less or that you received less in revenue for your units that you sold. And that is not generally a good thing. And so when we see a negative number for sales variance, that is considered to be unfavorable. When we see a positive number for a sales variance, that is considered to be favorable because it means that we sold more or we made more per unit. Now let's take a look at the sales volume variance. The sales volume variance is a change in the contribution margin due solely to the variance between the actual and budgeted number of units sold. So this one has nothing to do with the price and everything to do with the number of units that went out the door. And so the formula here is budgeted contribution margin per unit times the actual number of units sold minus the budgeted number of units sold. Another little simpler way to think of this is the budgeted contribution margin times the difference between the actual and budgeted number of units sold. And remember, actual always subtracts budgeted. So if we go back to our example here, the first thing that we need is our budgeted contribution margin per unit. Well, we're not just given that number. We have to figure that one out. We know what the selling price per unit was budgeted, and that was $17. And we know that the budgeted variable cost per unit were going to be 10. So the budgeted contribution margin per unit would be that 17 minus 10. That would be $7 per unit. You're going to multiply that by the difference between the actual and budgeted units sold. The actual units sold were 11,000 units. The budgeted units sold were 10,000 units. So there's a difference of 1,000 units. Multiply that by the $7 budgeted contribution margin, and we have a positive $7,000. That is a favorable variance based on the information we talked about just a moment ago. If it's positive, is deemed to be a favorable variance when you're talking about sales. Finally, we want to get to our total sales variance. And our total sales variance would be the two other variances added together. So we take our negative or unfavorable sales price variance of $11,000, add it to our positive or favorable sales volume variance, and the net number there is $4,000 negative, meaning unfavorable. So we have an unfavorable total sales variance of $4,000. That should match the total difference between the budgeted and actual contribution margin. And so if we ran the numbers for that problem through a contribution margin analysis, the budgeted numbers would look like this. We had a budgeted sales price of 17, a budgeted variable cost of 10, and so we had a budgeted contribution margin of 7. We multiply that by the number of units that we budgeted to sell, which was 10,000, and that gave us a budgeted contribution margin of 70,000. Then we look over here at actual. We know our actual selling price was 16. As far as we know, there was no change in the variable cost, so it was still 10. But we do know that we sold 11,000 units instead of 10,000. So our contribution margin of 6 times the number of units we actually sold of 11 gave us a contribution margin of $66,000. When we take the actual and subtract out the budgeted, we have a net difference of $4,000, and that matches the $4,000 that we saw up here when we added our two variances together. This will end this video. If you need a refresher course on materials variances and labor variances, there is another video posted with those. And then once you have a good handle on all of your variances, we have a sample SIM posted.